In 1986, Congress buried a single tax provision inside 429 pages of new legislation, and not one accountant hired by a middle-class family has ever explained what it means. It's called cost segregation. The IRS has approved it since 1959, and in the 40 years since they quietly expanded it, the people who benefit most have never been the people who needed it most. Here's how ordinary this actually is. You buy a house. A rental property, a small commercial building. The IRS lets you depreciate it right off its value slowly over 27.5 years for residential, 39 years for commercial. That's the number everyone gets. That's the standard. What most people don't know, what their tax preparer almost certainly never mentioned, is that the building isn't one asset. It's dozens. The carpet, the electrical, the plumbing fixtures, the parking lot. Each one depreciates faster. Some in 5 years, some in 15. And when you separate them out, the tax benefit shifts from decades from now to right now. In 1997, the U.S. Tax Court ruled on a case called Hospital Corporation of America versus the Commissioner. The IRS had been fighting this strategy in court, fighting it quietly. Because what the ruling confirmed was that any property owner, not just corporations, not just hospitals, had the legal right to break a building into its component parts and depreciate each one at its own accelerated rate. The court said this was always the law, not a loophole, not a workaround. The law. The ruling didn't make the front page. It didn't trend. No one called a press conference to explain that a landlord with a single rental unit could legally accelerate tens of thousands of dollars in deductions. A cost segregation study on a $400,000 property can move $80,000 in deductions into the first year alone. The IRS knows this. It publishes the methodology in its own audit techniques guide. You can read it on their website right now. The official explanation for why most people don't know this is that it's complicated. Cost segregation requires an engineer, a specialist. Studies cost between $5,000 and $15,000. And for a small property owner, that cost has historically been the gatekeeper, the thing that priced out the middle class and kept the strategy inside the portfolios of institutional investors and real estate funds. That's what they'll tell you. And the cost barrier is real. But it doesn't explain why the IRS Audit Techniques Guide isn't covered in a single standard tax preparation course. It doesn't explain why the major software platforms don't flag it automatically for rental property filers. The complication was always there. The silence around it was not accidental. Now here's the number nobody talks about. According to the American Society of Cost Segregation Professionals, that organization exists. It has thousands of members. It has operated for over 2 decades. Fewer than 2% of eligible property owners have ever had a cost segregation study performed. 2%. There are approximately 20 million individual landlords in the United States. Most of them own between 1 and 4 units. Almost none of them have heard this term. Meanwhile, the top real estate investors in this country deploy cost segregation on every acquisition. Every single one. It is standard operating procedure for every private equity fund, every commercial developer, every REIT. The people who already have tax attorneys have known about this since 1959. The people filing with software have been handed a 27.5-year straight line and told that's the only line there is. And here's what makes the silence impossible to dismiss. In 2017, the Tax Cuts and Jobs Act expanded bonus depreciation to 100%. That means a qualifying component wasn't just accelerated, it was immediate. Year 1, full deduction. That passed in December 2017. You did not hear about it on the evening news. Your tax preparer did not call you. Think about what that means. For 40 years, the single most powerful legal tax reduction tool available to property owners has been systematically used by the wealthy and systematically invisible to everyone else. Not because the law excluded the middle class. The law never excluded the middle class. What excluded them was access. The knowledge gap between a real estate attorney and a tax software dropdown is worth thousands of dollars a year in deferred taxes. Compounded over a career, over a portfolio, over a lifetime, it is the difference between building wealth and renting it to someone who already did. The IRS publishes this. Congress wrote it into law, and the financial industry that profits from middle-class ignorance, the preparers, the platforms, the banks that would rather you carry a mortgage for 39 years than understand the asset inside it. None of them had any reason to explain it. So ask yourself why, in 40 years of tax prep commercials, in 40 years of financial literacy campaigns, in 40 years of small landlord forums and first-time investor seminars, no one thought to put this on the screen in plain English. The IRS guide has been public the entire time. The court case is settled law. The math is not complicated. Who benefits from a 2% adoption rate? Because it has never been you.